What's happening, travelers? Nitzan Moser here, the Traveling Investor, and welcome to another week of the Traveling Investor Show. And this is where you're going to learn how to master your mind, body, and wallet. It's been an awesome week. I want to welcome everybody for being here right now. And we've got a great show this week. We have, this is where you're going to learn, like I said, how to master your mind, body, and wallet. And every week, I'm going to bring on guests that can help us understand how to master ourselves holistically, right? Whether it's how to focus on our mindset, focus on our bodies, or focus on our wallets, right? And when we talk about the wallet, my whole point in doing what I'm doing is to help you create a business that will revolve around your lifestyle. We're so caught up in the world today where we are running around chasing after the dollar, chasing after, money because we have more month at the end of our paycheck, right? And my goal is to help you create passive income so that you can go out and live life on your terms, right? We were all taught in school to, get a good education. We're done with high school, go to college, get that job, work at that job until we're 60, 65, 70 years old, whatever it is, and get that watch, that gold watch, and retire in our golden ages and then start living life. Well, I was sold that dream. I started that dream. I was on that road to that dream. And then I realized that wasn't what I wanted. It wasn't the life that I wanted to live. I did not want to be able to start living my life at the age of 65. I wanted to live my life now. I wanted to create memories with my family and friends and go out and enjoy life to the fullest. And this is why I have created the Traveling Investor Show and why I do what I do. And today, this week, I've got a great guest. His name, and I hope I get his name correct, Lane Kawaoka. All right. And Lane has been investing in real estate for over a decade and now controls over 4,500 units. That's 4,500 units all around the country. As the owner of crowdfundaloha.com, simplepassivecashflow.com, and reialoha.com, Lane is responsible for finding investment opportunities, analysis, and marketing. Now, he's also obtained a BS in industrial engineer and MS in civil engineering and construction management from the University of Washington. In addition to an analytical engineering background, Lane has real-world experience in working as a project manager for over $250 million of capital construction projects in both the public and private sector. So you see, Lane did it. Lane was in that field, right? Lane was in that path of going to school, get that education, right? Go out and use that diploma and work and build up your career. But then, we're going to find out what happened that made him do that shift, right? Working as a high-paid professional in corporate America and frustrated by the traditional wealth-building dogma, as we were just talking about, Lane was compelled to inspire and mentor other working professionals via his top 50 investing podcast at Simple Passive Cashflow.com. And what I want to do right now is I want to welcome Lane. Hey, Lane, how are you?
Hey, aloha, everybody. Let's get to it. Let's learn how to invest. How do we get quit our jobs?
That's right. That's right. So, so tell us, are you're originally from Hawaii, from the islands?
That's correct. I grew up here, went to school at your University of Washington, was up in the Northwest for about a dozen years, but live where you want. Best where the numbers make sense. So
absolutely.
Hawaii.
Absolutely. That's fantastic. So, so Lane, so you started out, doing, that path that we're told to go out and to do, right? Go to school, get the education, get the job. Obviously, you had a very successful career, as a project manager of over $250 million of capital construction projects and whatnot. So why don't you, in your words, tell us where you started and what happened that made you have that transition over into real estate?
Yeah, so I kind of grew up in a family where they taught us to be very frugal with our money, be a good little boy, go to school, study hard, and work at that job for 40, 50 years. Exactly what you're saying. Get that golden Seiko watch. The Rolexes are too expensive. And that's exactly what I did. Just followed that linear path that I think a lot of working professionals do, where you go to school, you study hard. For some reason, I must have been good at math and science, so I became an engineer. Went to University of Washington, got my degree, started working as a construction supervisor. And once again, following all that financial dogma, they say, go buy a house to live in. That's what I did. And then I started to realize, like, well, I got this big house and I was working on the road a lot of times. As most young professionals, they send your butt out on the road, traveling all the time. And I just decided I was going to rent it out. This was back in 2009, before they had, Turo and all these other things where you rent your stuff out. I just thought that house was sort of underutilized. I think they didn't even have Airbnb back then. So what I did was I just found the property manager and started renting it out. The rents they brought in per month were $2,200 a month, and the mortgage was $1,600. And to a young 20-something-year-old kid, that was all a beer money back then. But then a few weeks went by. I'm no dummy, and I realized, hey, if I just do this a handful of more times, I'll be able to quit my job and fire my boss.
That's awesome. That's awesome. And so you were able to go out, create passive cash flow for yourself. And were you able to fire your boss?
Well, it takes a while, right? For a lot of working professionals, we make, six figures and above. It's going to take a lot of time and rentals to be able to replace your salary. And I saw this. I can do a spreadsheet. I can figure out how long it's going to take. This is not a get rich quick thing, right? But it's a passive investing situation where I continue to work my day job, bought a handful of more rentals in Seattle. In 2012, I had a pivot point where I realized sophisticated investors don't buy properties in primary markets like Seattle, California, Hawaii, New York, Boston. Numbers don't make sense. And when I mean the numbers, like the rent to value ratio, we're looking for something that's 1% or higher. So you find the rent to value ratio by taking the monthly rental price divided by the purchase price. And you need that 1% or higher to be able to cash flow while paying all your repairs, expenses, maintenance, third-party property management, because we don't want to be landlords. We're investors here. And then to stockpile some cash for those big mishaps in the capex and vacancy and those types of things. So I started to invest out of state in Birmingham, Atlanta, Indianapolis, and then in 2015 I had 11 rentals, all cash flowing for me.
That's great. That's great. And yeah, I agree. Going out into the primary markets, for cash flow is not it's not a strong point, right? It's a place where you can find some good appreciation, but the cash flow is very low because you're paying a lot of money for the assets, right? The amount of money that you're collecting versus the mortgage payments that you'll have to pay and so forth. So were you stationed on the islands, or were you on the continental US during that time?
Yeah, so for about 12 years, I lived in Seattle, traveled all around Montana, Nebraska, down to Texas. And throughout this time, I was able to save a lot of money because I didn't live at my residence in Seattle. I was renting it out. I just lived off the company dime, right? Just off the company credit card, housing and meals. So I was putting a boatload of money into investing into my rentals. So, on the scale of, I think like 50 or 100 grand every year was going to buy real estate. And, I'm not a big advocate for all this creative financing. And to me, that's kind of for lower net worth guys that don't make much money. But for like the working professional, it basically comes down to how much you net at the end of the year, how much you can save to put the 20% down payments.
Mm-hmm. So how would what would be some of the things that you could tell, new investors, new people that want to get involved in real estate, want to start creating something like what you've created? What would be their first, the top 3 or top 5 things that they should do first before getting started in real estate and acquiring some rentals?
Yeah, it depends where you are first, right? And when I kind of talk to new investors, kind of help them out, I kind of see where they're at, and this typically, rudimentally comes down to how much money you got. How much money do you make every year? If you're a broke guy who doesn't make more than 50 grand a year, I don't know if I'm the person to listen to, right? Like I work with high net worth working professionals who make a pretty decent salary and can parlay that money to just passive investing. But if you're able to save at least $20,000 a year, or have maybe 20 or 30 grand of liquidity, and your net worth is under a quarter million, certainly not a credit investor, like I would start off with a single family home turnkey rental. Turnkey rentals are a great way to get started. They're kind of like training wheels for investors. A rehabber will fix up a beat up property, put in new flooring, new appliances, new roof, new plumbing, HVAC, kind of set you up, right? Sometimes they'll even put a tenant in there for you. And this is how I started, right? I did not think about rental real estate. My parents never did this. I didn't have a clue, especially when I did it remotely, right? And I never even saw the properties to begin with. So, that's how I would say to get started. And you might buy one, you might buy three, you might buy five, but at some point this grows your net worth a lot faster than doing the stock market and that type of stuff. And then at that point, you jump into syndications and private placements when you become a higher net worth investor.
Right. So how did you go about acquiring 4,500 units? Share us that story.
Yeah. So around 2015, I had 11 rentals, which is cool. I mean, each property brought in a few $100 of cash flow, and I was cash flowing maybe like $3,000 a month. So at that point, I was, that was maybe a part of my salary. By no means was it half, or was I able to quit my day job quite yet. So I needed more rental properties. I needed more assets that created more income for me. So I realized that at that point, to give people a little insight what it's like to own 11 rentals, it's a little bit of a pain because with 11 rentals, I had an eviction or two every year, some kind of big catastrophe that happened every quarter. Like tree falling in the house, plumbing repair, some kind of hurricane or something that happened. And then, in conjunction with bad tenants here or there, I realized that, it was sort of a pain. Yeah, I had professional property management to deal with these headaches and issues, but the problem there was, that exception rate for $3,000 a month, that's not enough. I need $10,000 a month, or what a lot of my clients say is their kind of their goal, their immediate goal. So I need 30 houses. So multiply that exception rate by 3, and you can quickly realize how this becomes unscalable. So I started searching around, found syndications and private placements as a passive LP partner, where none of the debt gets put in your name. You're not doing any of the management duties, and quite frankly, you're in better deals, right? Turnkey rentals, remote rentals, you're just pretty much buying it turnkey. There's no value add. Where syndications, there is usually a business plan to bump the NOI to increase the value. So at that point, I started to interact with higher net worth accredited investors, and I found the world of all these other wealth building strategies where the wealthy don't really pay taxes because they utilize passive activity losses, cost segregations, they do infinite banking. And I realized there's a lot of cool stuff out there that are very simple. That's simple passive cash flow. And I realized that, it frustrated me that the average Joe out there who's working his butt off, the shrinking middle class, they'll never get ahead because they're using all these really bad wealth building strategies that you're kind of duped into going into. And like we said at the start of the show.
Right. Absolutely. So that's it's amazing. That's why I like real estate. Just like what you said, all of the cost segregations, depreciation, things that you can use to offset your income so you don't have to pay higher taxes and you keep a lot more of that cash in your pocket as well. So tell us about the Simple Passive Cash Flow and the different, well, let's start with Simple Passive Cash Flow. What is that? And how did you start that?
Yeah, so I started it back in 2015 and 16 when, at the time I was buying turnkey rentals. That's what I was doing at the time as my net worth was growing. And I think that's just a progression of investors for most people under $1 million net worth. You got to get your net worth up to a respectable amount to get into larger syndications and private placements. So at that point, I started to, all my friends would ask me, even before 2015, Like, well, how are you buying these rental properties in Birmingham? You don't even visit it? That's crazy, man. And you got like 10? You got more than one? That's crazy. So, I mean, I think a lot of us who listen to these financial, we're financial fanatics, right? And we geek out on this stuff, and we might mention it to our friends, and they'll kind of waste their time asking. Now, they wasted a lot of my time asking me how they did this, and I got frustrated. And I was like, you know what, man? You're obviously not going to do anything. I am just going to record this stuff so that even like when I moved, I eventually moved off to syndications and private placements as a credit investor and got into a lot of this other tax and legal kind of sphere. But I wanted to put it in a place where my friends could kind of recapture it, right? If they wanted to kind of follow along on the journey. So that's where Simple Passive Cashflow podcast was born in 2016. And it just got really popular after a while. And eventually I kind of turned it more into an credit investing channel. But yeah, I think the problem for most like people coming into this is like you're drinking from a fire hose. It seems like really confusing. You're talking about all these like different strategies, tools, but to me, it's like there's just a lot of noise out there. I mean, for high net worth working professionals that we work with, it's really simple. Like in a nutshell, the flow chart that I use, and I'm an engineer, so I like flow charts. You got to go into good deals first, right? Syndicated deals or private placements, because now you're unlocking all the passive activity losses. So you can pay less taxes and play different levers and games with your taxes. Therefore, you keep more money, and now you can invest it more and invest it and create that vicious cycle. But also now you have a lump sum of money that you can put into an infinite banking policy, a whole life overfunded insurance. Again, this is something that most like Susie Orman, Dave Ramsey, they absolutely demonize this stuff, right? But why? What is the wealthy doing? They're doing it a little bit differently, and that's how we kind of teach people how to do this stuff and empower them with the right information, empower them with the right tax and legal advice. But of course, go to their professionals to implement them, right? But the important thing is that the investor is armed with the right information to be able to have an educated conversation with the professional. Because, most times, 95% of the time, my clients have to fire their professional because they just aren't good, right? Most working professionals, and this is how I was when an engineer, I just did it the easy way, the conservative way, right? That may not be totally aligned with what's best interest for the client. And most people are probably in this situation. They probably need to find a new CPA or lawyer, but more importantly, they need to arm themselves with information to be able to steer the ship. They need to be able to dictate to the professional how they want things done, if not the easy way, which is not what's going to be the best for the bottom line for that client. So it's all about empowering yourself as an investor, as somebody paying your own taxes. It's your biggest expense. You better pay attention to this stuff.
Yeah, absolutely. I agree. It's very important to have the right professionals on your team so that they can help you plan ahead and plan for the future, but plan for the present as well. So that, like you said, you don't have to come out of pocket and pay all those taxes and keep a lot more into it. So, a lot of people, when we talk about real estate and when we do these shows, everybody's talking about how awesome it is, how much money they're making and things of that nature. What were some of the hardest lessons you've learned in doing syndications and buying rentals and real estate?
Well, I made a lot of mistakes when I first started out. Like the basic one is like, I thought I was smart to pay off my mortgages. It's not. You want to carry debt that is, of course, prudently, right? Where you cash flow, where you have a good debt service coverage ratio. But, if you pay down your properties, your return on equity is low. And that's really the most important thing. How is the impact to your net worth? If you have a paid off property and you're still making the same amount, 20 grand, on the investment, you're likely making in the low single digits. Shoot, you better be off in a savings bond for as much liability you're taking on with a rental property, right? So that's the important thing that sophisticated investors do. They prudently, check at their investments. It may mean doing a 1031 exchange, which I don't like. I don't recommend those at all with passive activity losses and cost segregations, but I digress. We don't like, or you can also do HELOC, right? To get at the equity, you can sell the asset, right? You're constantly pruning your portfolio. It's kind of like I bought these coffee farms, and like the coffee plant grows, and what you want to do is you want to kind of chop off the larger sections of the tree because it's not growing coffee beans. And this it's just like your portfolio. You want to prune your portfolio so you keep that return on equity high.
Right, right, absolutely. So, when it comes to syndications, or when it comes to finding the properties, how do you go about finding, different properties and the different markets that you want to invest in?
Yeah, as far as markets, we target places in the South where there's good economic and population growth. What I really look at is rent growth. To me, that's the one. It's a clean set of data that you can look up that I think is a indicator of population economic growth. So that's where I start off first. And a lot of these markets, I think everybody's heard of: Phoenix, Dallas, Houston. We like Huntsville, Alabama. I got over 1,000 units there. Georgia, Florida. These 5, 6 states are going to kick the butt of the other 45 any day. More landlord-friendly states, red states, obviously. But the way we get deal flow today is just strictly by brokers. We only go after stabilized apartments. We don't go after distressed stuff. Our business plan is to take over a building that we step into cash flow day one, right? Because we feel like that this is the prudent way of doing things, where we are able, if a recession comes, we're good. We'll just continue the cash flow, right? Maybe we get the rehabs done, cheaper at that point because people are out of work. But, the majority of the way we make money is through value add. So fixing up the property, putting at least $4,000 to $6,000 into every unit, new flooring, new appliances, new playground equipment, new paint job, but not really getting into any big scope, right? All we're trying to do is bump the rents up $100, $200 across the board, but that's enough to really change the net operating income, which impacts the market price that we get at the end.
Okay. And let's talk about your team, right? Obviously, you're not a lone ranger. You're not out there doing everything yourself, right? Who do you have on your team right now?
I mean, a lot of people we have are like third party. I mean, so yeah, it is. We run a boutique syndication company. I'm head of investor relations, and we know all our investors. We want to build a personal relationship with them. But yeah, we really believe in third party. I mean,
Third party management.
If management is not performing, it's not hitting our KPIs, we fire them. We get another one, because we've done that a couple of times at least.
Right. Yeah, sure. Management company is one of the more important team members, right? A good property management can make you money, and a bad one could sink the ship.
Right. I don't like to call them team members. Team members are equity investors and people in-house staff. Property managers to me are vendors. Just like when I owned turnkey rentals before, people call them their team. They're not totally aligned with you, right? And they're sort of like guns for hire employees in a way.
And when you're looking at a property, what are some of the key metrics that you're looking for that will kind of ring the bell for you and say, this is a great opportunity for us?
Yeah, so I mean, you're gonna look at the profit and loss statement and rent rolls and ensure that is this property cash flowing, period. Right. But then the thing that makes a deal for the most part are the rents undervalued, right? I mean, that comes in with comp analysis, and there's a lot of good data sources for residential commercial properties such as CoStar. The data's out there. I mean, and it's a great way to kind of do that, analysis from the computer, but nothing really replaces walking the comparable sales. And this is where, we work hand in hand with our property management companies. They can also come up with their, we like to call it independent cost budgets for rehabs, deferred maintenance, and operating budget. I come up with our numbers, the team does, and then they do. And we want to kind of see where they fall. And it's just multiple eyes kind of coming up with that, blessing, hey, here's the budget that we can hit.
Right. And so let's talk now about your investor base. How do you go out and find investors to come into your deals?
Mostly just referrals. I mean, we perform well. They tell other people about us. And at this point, we kind of bring in people that we like referrals for the most part because they understand. We don't want unsophisticated investors that are going to hang us at the end of the day. We want to have relationships with our investors, because, I mean, COVID could happen. We don't want investors to get upset because we withheld distributions for the health and longevity of the asset, because they wanted they think that their distributions is like guaranteed. But, I mean, it's like, hey man, like, we had this little thing called COVID-19. We decided that we were going to hold back these distributions because, we thought it was a prudent thing to do,
Sure.
so sue us, right? Or
Mm-hmm.
hopefully they don't sue us for something like that, right? But investors out there do that. And look, all we're trying to do out here is being prudent with people's money, work hard for them. And we kind of look for people that have the same wavelength in terms of outlook.
Right. Absolutely. Absolutely. It's to look out for your investor is to look out for the asset, to make sure that the asset is performing. That's how you can make sure that your investors are doing well at the same time, right? If you're focusing on the investor and, like you said, creating distributions and, choking the property, that's not really in the best interest of the investor, right? You want the property to flourish and to function and to maintain itself and to keep going for the long term, so that later on it could pay off a nice distribution to the investors, and then later on sell it for a profit. How long do you usually hold your assets for?
I mean, we've held properties for as short as 3 years. I mean, it depends, right? I mean, depends on the market, depends on how much of a hassle the property, the tenant base is to deal with. When we first started out, we did a lot of Class C properties, a lot of headaches involved with those types of tenants. Worse than average collections is pretty typical.
Right.
So, once we hit the business plan, which is usually to double people's money, we look to sell. But if a market is still strong, market indicators are still going well, we look to refinance and hold and hit that infinite return scenario by refinancing people's money out, keeping them as equity. So it depends, right? I mean, once investors are in, a dozen or more deals, it just kind of becomes minutia at that point, right? I mean, currently I have like over 30 properties, and it's like it kind of starts popping like popcorn after a while.
How did you go from 1 or 2 and scale to 30?
Just kept buying property every quarter for the most part. I mean, it all starts with the first one's always the hardest, right? First turnkey rental, first syndication. I mean, it's always the hardest, but to me, I think there's no other way of doing it once you hit a net worth of $1 million or greater, because the beauty is you get to diversify over different projects, different asset classes, different geographic areas. And, like when you do have a capital event and you have to recapture the depreciation and capital gains, I mean, you should have a stockpile of passive activity losses. Some people have often over a few $100,000 or $500,000 of passive activity losses after a while. That kind of offsets that.
Right. Okay. And when it comes to asset management, do you hire a third-party asset management team, or do you do that in-house?
No, that's us. I mean, we're the asset managers. And depending how you do it, it can be you can kind of run yourself and turn yourself into a property management, or you can run it, I think, which is the appropriate way, which you're driving for KPIs. It's no different than single family home, owners, right? You can ride your property manager and ask them to get 3 bids on like $100 hammer every time, or you can empower them to make the right decisions and trust but verify. I mean, there's different ways for people to do it, but we've kind of built rapport with our sets of property managers that they know how we want to do it, and we want to kind of. At least this is how I worked when I was in corporate America and I had construction staff. I mean, I was a supervisor. I go to my foreman and assistant foreman, and those are the guys who I interact with, and I empower them to make the right decisions. Whatever they
Right.
need, that's what I get. That was my role. And in a way, I'm still in that same position as the managing manager.
That's great. Do you bring in other people to partner up with you on the GP side of your syndications, or do you do it all on your own?
Yeah, we tend to keep things very small. We don't want too many cooks in the kitchen.
Uh-huh. Yeah, that could definitely get get a little tricky when you have a lot of people sticking their hands in there, right?
Yeah, exactly.
Do you before you acquire a property or a new market, do you actually get on a plane or in a car and go to that market? What's your
Oh
process?
yeah, bet your butt I do. Right. I mean, for a lot of the investors, they never go and visit these properties. And every deal I do, I'm putting my neck on the line. So yeah, I'm gonna kind of do my due diligence as best as I can. And I'm gonna put my own money and my own skin in the game.
Mm-hmm. And how do you structure your syndications? A lot of times people will do a 70-30 split, an 80-20. Do you kind of tend to stick to those metrics, or do you have other ways of doing your syndications?
Yeah, I don't like those complicated waterfalls. I think when it's done like that, it's confusing. Normally, it's just a transparent, you know, 80-20, 70-30 split. I mean, it depends, right? Like if it's a fatter deal,
Mm-hmm.
heck yeah, I'm going to take more as a general partner. But if it's a thinner deal, might go less, right? I mean, people are always asking, oh, what's the better deal? It's like, dude, they're all the same, right? All the deals, like as a passive investor, we know what you guys kind of deserve. You're buying a commodity, right? If it's a fatter deal that we find off market and it's just absolutely crazy, we'll take more as a general partner and we'll be transparent about that, right? At the end of the day, we're signing up to hit your expectations, which is a certain amount of returns
Mm-hmm.
at the end of the X amount.
Right.
And it may be more, it may be a lot more, it may be less, right? But on the long term, like we want to hit investors' expectations and set it there the right way, because I mean, we don't get rich off investing in one deal, hitting a bad, not hitting their expectations entirely and not investing in us. We need people to invest continuously with us in multiple deals and refer their friends.
Mm-hmm. Sure, absolutely. Right. Multiple, right? Repeat customers. That's
Go figure,
true.
right? I mean, it's like we're not trying to just take everybody's money and like run away to Mexico, right? We're trying to run this as a legitimate business. I'd like to do this for 20, 30 more years.
Right. Exactly. Right. This is a great business to be in. You can do it from anywhere in the world. If you have a laptop and a phone, you can buy properties anywhere in the world from anywhere in the world. Right.
Right.
That's kind of why we do this. So what other advice would you have people getting involved in syndications?
Do your due diligence, find other pure passive accredited investors to network with and build real relationships, not just have like one random beer here or one phone call.
Mm-hmm.
Go in deep, right? It's better to know one or two passive accredited investors and be good buddies with them than to know 20 or 31 that you're just kind of loosely affiliated and Facebook friends.
Right.
Go in deep.
Right. How do you find your investors?
Well, I'm lucky. I mean, I have a podcast and they call people book calls with me like every day, and I'm kind of a lightning rod for that. But that's not very practical information for people listening right now. My advice to those people is at least stay away from the run-of-the-mill real estate clubs, because a lot of those avenues are just filled with a bunch of broke guys, or the free real estate forums. Right? It stands for broke people. Right? Those are not the crowd that you're trying to interact with. You're trying to find pure, passive, accredited investors, or typically high net worth, working professionals. I'll even also go a step further and say, yeah, some people are like, all right, I'm going to go to a country club. But most of my investors are first generation wealth. They don't go to a country club. Right? Country club is filled with second generation trust fund kids, and they invest a little bit different. They even care about investing, right?
Mm-hmm.
So it's difficult. It really is difficult. But I think it takes a few years if you're not screwing around in the wrong places to kind of find the right small inner circle.
Right. Yeah, absolutely. Right. Finding those investors, right? That's the key to longevity in this business, right? Being able to find the right investors that are going to continue to invest with you. And like you said, the second generation trust fund babies, they don't care to invest. They made their money the easy way. They were born into it. right?
Right.
It's the people that work for it, that understand passive investment, and understanding that, you know what, let me put out some of my cash and have them come back to me with some friends.
Right. And
Right.
that's like, even beyond investing, right? Like who do you invest with, and maybe more importantly, who not to invest with, right? That's what you're going to get through a peer group. But as I've seen within my tribe, I mean, people, they get their oxygen mask on, they get financially free, and it's these connections that they built on square one on the journey is the people that they rely on. Like, hey, how are you building your family trust? How are you raising your kids? What kind of value system are you kind of bringing them up in? And I think everybody's listening right now can agree that they don't have many people in their circle, their friends, their family, their coworkers that think this way, that
Mm-hmm.
don't invest in the stock market or don't do their 401k at work, that question buying a house to live in. These are sort of crazy ideas. But
Right.
these are the very simple passive cash flow values and ideas that I think is the quickest path and safest path to financial freedom.
Sure, sure, absolutely. I joke a lot, but my father, when I was a little kid, he used to tell me, two types of people in this world: those that pay rent and those that collect. And son, you always want to collect, right? And that's kind of the mindset that we have to teach our children and other people. And that's also, I guess, the kind of mindset that we're looking for when it comes to investors, right? People understand passive cash flow, understanding, I do what I do, but I want to have that passive income so that I can retire early. I can have the freedom to do what I want, right? This is kind of the investor base that we're looking for. I remember when I started, when I moved back to the States in 2009, my network was zero. I had to go around and I was doing exactly what you said. I was going to these different RIAs and I was meeting all these broke people. I have a shoebox full of broke business cards, and at the time. So it's very important to understand who your investor is, right? And kind of go out and network where they hang out.
That's correct. And yeah, sometimes I got to catch myself that you start to fall in this elitist attitude, right? But I mean, the way I see things is like when your net worth is under $500,000, you're
Mm-hmm.
broke. You got to make money. You got to work at a job. And my path was working my engineering job and just saving up my money until I got to that point. And you start to realize like money is not everything, but it sure makes life a lot easier, and it definitely separates mentalities. Of course, there are those people, those trust fund kids that just got born with it, and you can usually spot them out pretty easily. I can tell in the first 5 minutes of interacting with folks, kind of hearing them talk. But that you're trying to find people on the same trajectory as you. I mean, and kind of consciously surround yourself with those people more.
Right. Absolutely. And do you do a lot of work on social media to attract investors?
Not really. I mean, I have my social medias, but I'll be honest, it's like people that are high net worth, busy professionals. They're not screwing around with that stuff. It's the same reason why, like as I saw recently, Lamborghini doesn't advertise on TV,
Mm-hmm.
because the dude that's can afford a Lamborghini ain't wasting his time on television.
Right. Right. Absolutely. I agree with you 100%. Right. So so you have to go look for these people, right? You got to go and you actually have to become the person that will attract the Lamborghini owner, right?
Well, I don't have any Lamborghini owners. Most of my investors are just hardworking professionals. They make between $100,000 to $600,000. Got a lot of doctors and dentists, and they're just hardworking folks. Good hardworking people with good values that most of them were taught to be very frugal. A lot of them are first generation immigrants.
Mm-hmm.
It's I mean, maybe you go out there and you drive around in the Toyota Camry, right? I mean, to me, that's the mentality, or at least if that's the people you're trying to attract.
Right.
I
Right.
don't go after trust fund kids and try and educate them on the benefits of multifamily real estate. I I'm passionate about people who really deserve it. The people who like the shrinking middle class, the people who went to school for college for dozens of years and they got kind of duped into this world of putting their money in the 401k, slaving away for 40, 50 years. That's what I've kind of set out to kind of write the world of.
Mm-hmm. Yep. Well, that's a great place to be, right? Being the knight in shining armor and helping these people with, build their passive income nest egg, right?
Yeah, because if not, they'll just listen to Cliff and Larry at work telling them to work till they're 65 so they can get even more pension. I mean, that's all. And buy a house to live in, invest in your 401k. I mean, man, like if people just realized or had people in their network that were financially free, they'd be telling them the complete opposite. But it's just unfortunate, right? It's just a bunch of dogma, financial dogma out there that pushes people in the wrong way. I mean, I was lucky. I kind of fell into a rental property, and very early on, I realized I was making like 20, 30% of my money with a rental property, and just a basic turnkey rental. When you include all the tax benefits, mortgage pay down, appreciation, and cash flow. And then I looked over at my 401k thing, and I was like, I'm only making like 8 to 10%, and there's all these fees in there, hidden fees.
Mm-hmm.
And I was like, what the heck? And then, I started to develop this mentality, and it started to get validated by many other high net worth people that, yeah, the whole system is engineered to keep the hardworking middle class working at their jobs. Because let's face it, if everybody bought a handful of rentals like how I did, I mean, who would build our bridges? Who would get our coffee? Who would, do our lowering for us or do our surgeries? Society would crumble. I mean,
That's true. That's true. I joke with my colleagues, my other colleagues in real estate, and say, if we all did what we did, we'd have to pay each other thousands and thousands of dollars to do stuff for us, right? I'll give you $10,000 to go get me a cup of coffee. Well, no, I'll give you 20,000 because I don't want to do it. I got something better to do with my time, right? So yeah, it's true, right? We're lucky that not everybody does what we do, and people do need to get educated and understand that, yes, there is a better way of making money, of living life. I stress that with my kids as well. I have two daughters, one's in high school, one's in middle school. And I always throw it in there that it's passive cash flow. For example, my daughter now, she's into, the Nike Air Jordans and all these sneakers, and kids are buying them and reselling them and doing all this. So I told her, I said, buy a pair of sneakers, turn around, sell it, take your money back, use the profit, go buy two more, go get your friend to help you out, pay them a little bit, and start doing your little business and earn, a little bit from everybody, and you'll make a lot of money. So now they're starting to do that, right? And it's just a mindset. It's just a different way of thinking about things, a different way of looking at it than, the norm, than what everybody else is doing, right? We have to educate people to an extent, but if they don't see it and they don't want it for themselves, then they're not going to go after it, right?
Financial freedom is not for everybody.
It's scary. Financial freedom is scary for people.
Yeah. The path to get there requires you to get outside your comfort zone. Most people aren't going to do it. So right. I mean, that's basically what it comes down. And like I said, it's the first one is the hardest. Buying that first turnkey rental.
Mm-hmm.
Signing your name on that 150-page PPM, right? And wiring out some money to some random person you met, right? It's scary. Hopefully you do your due diligence, right? Of course, but it's stuff that most people won't do, and you know what? That's a good thing, because for those people who do cross the bridge, it's better on the other side.
Absolutely. Absolutely. Well, Lane, listen, man, it's been a pleasure speaking with you. Time flies when you're having a good time, and you shared a lot of information with us. How can people get more information from you, or what podcasts? How can they find you? Share some information with us.
Yeah, so my podcast is simplepassivecashflow.com. Passive investing. I think if you're looking to buy rental properties, turnkey rentals, that's how the podcast started, but it eventually drifted off to more accredited investor speak, such as tax, legal, different aspects of syndications that I kind of teach as part of my investor education series. Email address is lane@simplepassivecashflow.com.
Awesome. Well, Lane, thank you so much for being on the show. I'm sure my listeners really got a lot out of it. Good luck with all of your real estate investing.
Yeah,
Appreciate
thanks
your
for having
time.
me. Well,
Yep. Talk to you
bye.
soon. All right, my friend. Take care.